Ladies and gentlemen, good day, and welcome to the BMR phone conference call on Decent Draft Model GST law released by Finance Minister Arun Jaitley. As a reminder, all participant lines will be in the listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. We would recommend that during the call, all participants who have questions can send them through an email at mahesh.jaising@bmradvisors.com, and we will address it during the question and answer session. I would now like to hand the conference over to Mr. Mahesh Jaising, partner, BMR Associates LLP. Thank you, and over to you, sir.
Thank you for the introduction, and good afternoon, everyone, and good morning to you, for those of you dialing in with different time zones. Before I get into the detail, I think the most awaited reform of GST is indeed now seems to be around the corner. What we seek to do today is that we sort of using the opportunity to discuss with you key insights around what the model draft GST law talks about, and also talk a little bit as to how this connects to the earlier versions of what each one of us has understood GST in terms of what the contours of GST will be. We'll also then talk a little bit about some level of detail on 4-5 key aspects, whether it's around the place of supply rules, input service distribution, taxation of services on a decentralized basis, and some other aspects. Before I go into detail, I'm going to hand over the call to my partner, Rajeev Dimri, who will give us a little bit more detail on to set the context, and then we will get into the detail. Rajeev?
Thank you, Mahesh, and let me add my welcome to everybody who's joined this call. Indeed, it is a significant development for people who have been awaiting GST for a long time. And this is for the first time that we have something tangible to put our hands to and start analyzing as to what the proposal from the government side is. We all have known the two-tier structure and various other policy aspects have been under discussion. But, for the tax people and for the business people to start making decisions, a more tangible version is now here. But as Mahesh said, that, it's one of the most awaited tax reforms that has been promised or expected in India. But last few weeks have seen certain material developments in regards to proposed introduction of GST. It is, whether we talk about the recently concluded Rajya Sabha election, where the government seems to have consolidated its position, and more importantly, the opposition seems to have lost some ground, and therefore their ability to single-handedly block significant reforms like GST or significant tax proposals like GST might have been compromised. So that's one significant development. Soon after the state elections and the Rajya Sabha elections, the government has also indicated its intention that they will put this constitutional amendment bill to vote in the monsoon session of the parliament. The finance minister was on record saying that the effort of the government had been to try and build political consensus around GST. However, that has eluded us for the last couple of years, and therefore the government intends to go ahead with the voting. I mean, we never know about the politics, how it will evolve, but the circumstances seem more favorable for the passage of the Constitutional Amendment Bill. And of course, release of this draft bill as a model law is a significant development to analyze and take things forward. As you all will agree, anything to do with law will take years for it to evolve and years for it to stabilize. However, the process can begin today. So I do think that a couple of these changes and developments that have taken place in the last few weeks are a material indicator to the government's resolve to try and push for the GST introduction at the earliest. The current target date seems April 1, 2017, and I think that's, while it is ambitious, but the work for the industry, for the companies, must begin in right earnest. And to take you through some of the details of the law, Mahesh and his team are going to take you through the fine print of the draft law. So thank you all once again, and Mahesh, over to you.
Thank you, Rajeev. So, just deep diving into the model GST, I think there are 4 or 5 key concepts that I thought we will get into. I think the first and foremost, which is a taxable event, is an area that we should spend some time. The GST will apply on supply. The taxable event will be a supply, and in the past, under the VAT law, the taxable event was sale of goods, and service tax was provision of a service, and excise was manufacture. Now we're going to do away with the VAT, service tax, and excise. We will have a GST, which is a tax on supply of goods or services. It is ordinarily leviable on a supply of goods or services for a consideration, but there are some exceptions, and those exceptions are something that we'll have to talk about, which include, amongst others, branch transfers and self-supply of services. So that we will cover, because that does have a little bit of debate and dispute around that as to what scope of applicability would the provision have for transactions without a consideration. But by and large, a transaction with a consideration will indeed attract a GST. As already mentioned, we all are aware that we're expecting a dual GST, and this bill well lays down the thinking of whether, when a transaction is a local transaction, it has a dual GST of a central and a state GST. When a transaction is an interstate transaction, it has an IGST, which the seller or the supplier will have to discharge in the origin state and charge to the account of the destination state. I'm going to come to that a little bit with some examples for us to understand that. So the concept of IGST has clearly been brought out in great level of detail, because when I do mention the word, when a transaction is interstate, what is indeed interstate is something that we will debate and talk about, and also more importantly in the concept of taxation of services, because that becomes far more difficult to understand in the concept of what is an interstate service, is something that these rules and this set of draft law has indeed made a lot of headway to understand taxation of interstate services. Before we go into those details and concepts around branch transfers and services tax, it's important to note that this draft law does not talk about a 1% additional tax, and we did hear that from the finance minister himself after the release of the draft law in press. He specifically mentioned and confirmed that we would now be dropping the 1% additional tax. So for product companies or for even service companies buying products, the 1% interstate tax which was a non-VAT tax, doesn't seem to be there, which is good news, because it makes it in some sense a pure GST. Moving forward on different concepts of sale and service, the law has gone ahead and defined some transactions to be deemed to be a sale and some to be deemed to be a service. So what transactions are deemed to be a service? Works contracts, lease transactions, and even supply of intangibles is being deemed to be a service. Now, what this means is that would it mean a lower rate of tax? Not necessarily, but more importantly, it at least is aligned to the request of industry to align taxation of lease and other transactions, to international best practices to treat it as service, because to be able to then apply the proxies of where the tax needs to be paid for service transactions is little more driven by where the contracting recipient is rather than where the consumption of the service actually happens. So again, I will go into a little bit more detail with some illustrations as we progress, but at this juncture, it's good to note that supply and service transactions have indeed been defined. There is some scope for further clarification, particularly around software, because software transactions are invariably debated as to whether it's treated as a service or goods. Anyway, the issue right now is that there's a dual tax. That should go away. Currently, software supplied electronically has a VAT and service tax. Going forward, at least it will be a GST, while software supplied electronically on a first brush should continue to have a service character. I think what Nathan answered is where software is supplied on a tangible media, so would that get a different character is something that we need to look out for. The next important concept is who needs to pay a tax of GST. I think the law is very clear in terms of the basic principle is that it's a forward tax. that, like it is today, that if I'm selling goods as a distributor to a reseller, I would need to charge the VAT, and therefore under GST as well, that principle applies. The same principle applies to a service provider as well as different, anybody in a supply chain. There are exceptions to this principle, and the exception is obviously that a reverse charge will apply on some transactions, and they've yet to notify the list, but it's safe to assume that transactions like insurance auxiliary service or commission agents, some of the recently notified reverse charge transactions will continue to apply. And more importantly, where a person is importing goods or importing services, GST would then apply on a reverse charge basis. The law also deems a concept of an aggregator, which is currently been there in the service tax law for a little over a year. That concept will continue under GST as well. So these are the three contours of a forward and a reverse charge with an aggregator. There are some aspects where the draft law provides for a tax deduction at source, works contracts and similar transactions. It talks about a tax collection at source for e-commerce companies, which I will talk about when we talk about 4-5 key sectors as we progress. Moving on to, I think, what would by and large be the most controversial part of GST is taxation of services, because historically what is a local or an interstate sale of goods is pretty much a settled concept. And yes, there's still some interpretations, but it's a little more easier to identify goods movement being tangible, what is an interstate or a local sale. But with respect to services, the concept of a service company today is that a company has a centralized registration, discharges taxes centrally, avails credit centrally, has centralized compliances. Under GST, the taxation would now happen at a state level. Now, when I make a statement, it will happen at a state level, does it mean, and that's obviously the question that is going to be answered by the place of supply rules, because there has to be a method in that process to determine how do you tax it at a state level, and we are going to get into that right now. So what place of supply rules does is that it says where a contract is between two registered persons, the place of supply is deemed to be the location of the service receiver. Even with respect to B2C transactions, where the registered location of the customer is known, it would be that location, otherwise it is a service provider. So in this example or in this statement I made that in a B2B transaction, the service is deemed to be supplied in the location of service receiver. Let's just take a simple example. There is X IT company doing a call center service to a customer, which is a telecom company, and the telecom company is located in Gurgaon, and the IT company has, 5 call centers located in 5 different states. And therefore the question comes up, in this contract, where would the transaction be taxable? Where would that IT company need to discharge tax? These are details that we need to go into, but I think the framework of the rules has considered a lot of inputs from industry and interactions that the government has had, and therefore I think it's going to be a little bit more simpler than what we would have thought would have been in a worst case scenario, that every service provider would need to figure out consumption of every service. So in this telecom example, if they have 20 circles, would the bill have to be split into 20? I don't think that's going to happen, but we need to get into a little bit more detail in the language. But in this example, the bill should and possibly be raised on the head office of the service receiver. And then again, what happens to the credit is something we'll come to later. But as far as the service provider is concerned, at least the location of service receiver is indeed going to be the head office in this example, which has signed the contract. Now, what's also relevant to note is that the government has brought out very specific proxies of how do you determine tax for some sectors like telecom, insurance, and banking. So in an insurance example, an insurance company, raising a premium on a particular policy holder, the law says that the place of supply shall be deemed to be where the particular unregistered person is located and where the insurance company has his address on record. So if there is if a insurance company has policyholders in 20 states, that insurance company needs to discharge tax for the policies and the premiums of the 20 states, and those 20 states, in effect, will start getting revenue on insurance contracts going forward. So I think the issue that comes up, which I don't think we can go into great depth right now, but we'll be happy to discuss that offline, is how do you hair split, what kind of proxies you apply. While in insurance it's a little more easier because there are PIN codes and people are, it's an individual. What happens where there are corporates that have multiple offices? So let's say a corporate is actually availing, a service from a particular vendor at 3 locations. Where would that invoice need to go? These are things that are, in some sense, sought to be answered, but they're still up for interpretation. It's important for us to look into these rules to understand the fact pattern, but it is safe to state that even as a product company, where I have pan-India operations and I have offices across the country, it's likely that I'm going to be creating credit pools in different states, and I would need to figure out how to manage those credit pools. Because under GST, getting your output tax is probably 20-30% of your job. But the larger issue and challenge would be to ensure that all the taxes that a company incurs under GST on the input side is indeed availed as a credit and is not lost out as a cost, because that's the whole idea of GST is that there should be a free flow of credits. Yes, the law does provide for that, but with the multiple state operations, the issue that needs to be answered is that if I build a credit pool in 10 different states, but I have, say, a plant only in one state, how do I transfer the credit to that plant? So before I go to that, I just thought it's useful for us to understand that these place of supply rules are pretty much the most critical document to answer some of those questions around taxation of services, and also to understand credit accumulation related issues that will arise in light of pan-India operations, either on the output side or on the input side. Moving forward, does the law provide for STP and SEZ units? Is there, currently we pay, as far as STPs and non-SEZs are concerned, you pay service tax on your input services, which you cannot claim credit because the output is exported, and therefore you sit with huge credits and file for refund claims. It seems that that is going to continue under GST as well. Currently, the scope of supplies to SEZ is not been definitively stated whether they will continue to have an upfront exemption like we have today with issuing a Form A1 or a Form I for interstate purchase of goods. Though offline, the authorities have mentioned that there still seems to be a thinking to possibly continue the upfront exemption for SEZ units, but for STPs, it's not there. But in the law, both STPs and SEZs, the law does not talk about any zero-rated or an exemption on the procurement by these particular units. And what the law does talk about is a refund will be granted where a company or where the registered person is indeed an exporter or there's an inverted duty structure. So we need to watch that space, because what happens if it is neither of the two scenarios, that I as a company, I have a plant in one state, in Gujarat, and I have credit that is built up in 5 marketing offices. What do I do with that credit? The first cut of this draft law does not talk about refund of credit that is just built up in 5 marketing offices. We will talk a little bit now when I move forward to the concept of branch transfers and possibly self-supply and input service distribution. So moving on to that topic of branch transfer and self-supply and input service distribution, what the law does talk about, and I think that's something that has caught the attention of the media and a lot of people, is that there's an entry that says supply of goods and or services by a taxable person to another taxable person, even without a consideration, shall be deemed to be taxable. So in some sense, what this is very clear, or rather this emerges, that this clause is what would result in a branch transfer from a company from one location to another, potentially having an IGST. So let's just give an example. I'm a company engaged into trading of printers. I import my printers into Mumbai. and when I import, I paid an import IGST. When I transfer the goods to 10 states where I have warehouses, the 10 states that stock transfer to myself will have an IGST as well, and that IGST should be offsettable by the respective branch when that branch is making a local sale. At this juncture, I would like to pause and raise a question which is food for thought for all of us, that do we really need branches going forward under GST for a product company? Because historically, branches were set up in an era when the CST law provided for a CST at 4%. That central sales tax had dropped to 3 and 2% respectively. So now when we do not have a cross-state non-vatable tax, I think it's fair to say that companies are likely to go back to the drawing board and not make decisions to set up warehouses purely driven by taxes. Those decisions would now be driven by what does the business really require, and that's the right thing, and the GST should be an enabler, and I think GST certainly enables this revisit of looking at your logistics and warehouse, but DHOS, that opportunity for us to go back. As things stand, the branch transfer should indeed have an IGST trigger that comes in, and then a tax chain continuing, because by this methodology, there is in some sense a cashless method of the taxes moving along with the movement of goods. The next point which the law actually has brought about some rules is an input service distribution. So let's say I'm a head office located in Mumbai in the last example. I receive an invoice for 1,000 licenses, for software licenses for my employees located across the country. This input service distribution provisions talk about transfer of credit where the service is in some sense relates to different offices. So the ISD concept, where some of us familiar with the SENVAC credit rules, would indeed continue under GST as well. And this provision implicitly clarifies to us that the billing from service providers can continue to be at offices that are not necessarily the consumption offices. So it's a little complicated what I'm talking about, but if in this example, if the ISD were to have its full meaning, which when you look at it harmoniously and incomprehensively, it indeed suggests that companies can source their services centrally and back-end transfer the credit to their respective branches. Now comes the most complicated question in terms of what happens to the credit that is indeed built up in these 10 states. So I'll stick to the example of either a manufacturer or a trader of printers. I imported all of them in Maharashtra and I did my sales across the country, but I have marketing offices in 10 states. These marketing offices incur costs like renting of immobile property, telecom lines, security, and so on and so forth. The place of supply proxy suggests that immobile property related transactions will indeed attract, in some sense, a local GST in each state. So let's paint this picture a little bit further, that these 10 states have about 10 employees each, and therefore, in some sense, it's very functional, and they therefore have third-party costs as well as internal costs. Credit pools are built up in respect of each state. This is a little bit debatable, but one can read the same provision that I read out, that in some sense, the marketing offices are providing marketing services to the head office if we were to visualize them as two separate persons, and therefore one could look at a concept of a self-supply to be able to have the branch office raise an invoice to the head office to transfer credits to the head office, and the head office can thereafter use that credit for onward supply of tax that applies on their manufacturer traded products. This concept is indeed a little complicated one. It has different dynamics to be considered. What kind of value does the branch office raise an invoice to the head office? Should there be a value at all other than for the third-party costs? I think as things stand, it's not a credit transfer. Had it just been a credit transfer from the branch to head office, it could have solved many things, but obviously states may be a little resistant to just credits of a state GST being transferred from one state to another without there being any underlying movement of goods or underlying movement of services. So while I'm not going to go into greater depth on this, by and large, I would think that this would fall in the top 5 issues of any company having pan-India operations, whether a product company or whether as a services company, and more importantly as a services company where there are centralized contracts. So moving forward from the concept of ISP and space of supplies, I think 2-3 concepts before I go into some implications on the key industries. The concepts include what would the point of taxation be. I think these are nitty-gritties, but I think they're pretty aligned to the point of taxation rules as far as the services are concerned. And as far as goods are concerned, it is the date when the goods are either removed or made available to the customer. Registration threshold that's been talked about is a 9 lakh threshold to be able to take a registration, and 10 lakh is when a trigger of tax comes in. So many of us are familiar that the state laws have a lower threshold and service tax has a 10 lakh threshold, but this is an area that I think most of us on the call would anyway be above that threshold, but it's good to note. The law does now have a fair amount of transition provisions. I'm going to come to that in a couple of minutes, but before that, I would like to highlight that the law also has a concept of valuation rules. What does valuation rules mean? Is that historically under VAT and service tax, as long as the supply is for a consideration and nothing else, the tax would be on a consideration. There were no concepts of related party transaction valuation under these two laws, but this particular GST rules does talk about valuation rules and brings about rules which are similar to the customs valuation for intercompany transactions and also which are prevalent in the excise law into the GST law. So we need to watch that where we have transactions between group companies, be ready that that would be under scrutiny, and also that would need to have a consideration that would pass the test of what is reasonable under the valuation rules under GST. So that's slightly a new concept that comes in, and this is an area that we need to watch out for. In terms of credit utilization, I think the structure remains how we thought it is, that IGST is offsettable against IGST and also under central and state GST, but state GST will be against state and central against state. While this is a little bit complicated in terms of the detail, but it's safe to say at this stage that companies having pan-India operations would have 3 credit kitties in each state, which is the central GST, a state GST, and an integrated GST. And importantly, one needs to look at what method we need to apply to be able to optimize all the credits that we build across the country and ensure that none of them is sort of written off, but effectively used in states that we have an output liability. I don't think the law is going to allow us a complete fungibility, so it's not that we just do some plotting on the drawing board and say, hey, let's transfer this credit here and there. There needs to be substance, and we need to look at it vis-a-vis the provisions of self-supply, branch transfers, and ISD, but that's something that we need to look at for our each respective company offline. In terms of compliances, this is aligned to the 4 rules that we had, 4 draft reports we had earlier on returns, monthly payments. So I think it's safe to say at this stage, for a product company, if we are making an interstate sale, all that we do is we write interstate sales CST, and we say without Form C or with Form C. Going forward, that product company needs to populate very comprehensively which state is the supply made for. So that return, which had literally one item saying CST turnover say 100 crores and tax 2 crores, would need to change to 29 line items for 29 states and for the union territories as well, whereby the turnover needs to be shown state-wise, and therefore, I think not only at the return stage, but at the invoice stage as well, we need to gear our systems and reporting quite comprehensively to be able to meet with the revised compliance and reporting requirements under GST. Because if you as a service provider or a seller of goods gets the wrong state on an invoice, that would mean a wrong state on the return, and that would mean a wrong, incorrect state getting a tax that is not due to him. And getting that money back from the incorrect state will be one process, but obviously the state that's not got the money is going to be after you, and therefore it's paramount and important to get your tax correct on the source document itself. Otherwise, this is going to indeed result in tax leakages and demands and disputes. With that, I thought it would be useful to talk about the transition provisions. The law does talk about transfer of credit, which is currently existing under the service tax and VAT laws would indeed transfer under GST. So that's not a big surprise, but it's good to note. What it also talks about is pending refunds shall be dealt with under the current law. I think one provision which we need to definitely go back as industry for those of us who are service exporters and having refund, it says that where a refund is rejected, in some sense you cannot avail a credit back and the topic closes. I think we need to engage with the government further. This first draft is indeed, the way I look at it, that we need to analyze this vis-a-vis our businesses and use this as an opportunity to populate the 5-6 items that impact us and see how we go back to the government to explain, because I think we're all ears to see if there are some gaps that indeed need to be addressed. This query in fact came by one of you on the call. And importantly, the other aspect on transition which is not addressed, which I think will impact in some sense the last quarter or the goods in hand in the transition, is that if I'm an importer, I incurred customs duties, CVD and other duties. I supplied the goods to a distributor and I charged a VAT. While the current GST law talks about that VAT credit moving to GST, the taxes that are in the supply chain which are non-vatable today, it's not yet clear how that will get encashed, and in some sense that's going to be a tax that's that will have a problem in terms of the company not being able to encash the credit of goods that are tax suffered in the supply chain and will again suffer a full GST as and when the goods are indeed sold. So I think with that, I think there's still some work to be covered around the transition provisions. It is fair to say at this stage that the Empowered Committee has indeed gone in and made a lot of effort to put this draft. We were engaged with a couple of the drafting committee members, and he mentioned that close to about 80 meetings have taken place in the last 1.5 years to 2 years to put this draft together. And I think it does show, yes, there are some gaps, there are some issues. And before I hand it over for the question and answer session, I would like to just talk about 3-4 sectors which are important and try to generalize it as well. So if I look at for the trading sector, we've got issues today of a central sales tax and origin-based tax. We have potentially entry tax issues, and as and when a trader is making a sale of goods, he charges VAT. You cannot claim a corresponding service tax, whether it's of the rent you pay on your business, whether logistics-related costs. All of these services have a service tax, and those taxes get in some sense lost, and that's why today's framework has a cascading effect of tax. The traders going forward in some sense will have a relief that all taxes that they incur for all procurements of goods and services in the course of business should indeed be creditable. This takes me back to one point that I didn't get into great level of detail. This draft rule also gives us the draft credit rules, and there are some aspects which were non-creditable earlier, which will continue to be non-creditable under the current GST. So to some extent, those provisions are old wine and new bottle, but there are some that have got a relief. A first reading suggests that construction-related services will not be available as a credit. Any service for the personal consumption of the employees is not available. Rent-a-cab services, it doesn't find a specific mention. There are two views that it should be allowed. Another view is that it's a personal service, though I would think that the first brush would say that it will be allowed under GST. So the credit scheme should be a bit liberalized. I think there's still room for it to be completely liberalized. But coming back to industry-wise and impact of traders, manufacturers, and service providers, I would think traders would clearly benefit from credit being available through the supply chain on all B2B costs. Manufacturers also would, in some sense, have the benefit of the credits being available through the supply chain of the goods. Manufacturers today are used to dealing with the excise authorities and the VAT authorities. So in some sense, from a change in how the compliances need to be done for a manufacturer, at least the start is that they are already dealing with 2 set of authorities and 2 audits and so on and so forth. So for them, it should not be a complete paradigm change. while there are different and many aspects that they need to look at least from a compliance perspective, as a starting point to get used to dealing with two set of compliances and process is something that should be relatively easier. I think the most complicated would be on the services side, because there are 3-4 aspects that one needs to see on the services side. One, which is the most critical part, is how do you tax contracts that are pan-India contracts? Where do you raise the invoices from, and how many and under a contract, how many invoices do you need to raise, and how much splitting needs to be done? Moving forward, service companies having pan-India operations. I talked about self-supply of services, issues around services, like even product companies have services to the extent of warranties and AMCs. There are some issues that arise there, that while the taxation of the transaction of the contract should be easy under an AMC, you will indeed have parts that move around the country. And how does that, when there's a part movement, there will be a GST that is tagged to that part. What happens to the credit in the respective state where the GST credit is built up? Those are things that we need to answer, but like I said, services is in some sense going to have the biggest change in turn, not only from a compliance perspective, but on the operational perspective as well. And also us on the product side, we're dealing with services either on the input or the limited output, would need to look at these place of supply rules. A couple of other sectors I thought important. One is e-commerce. E-commerce sector is will see 2-3 changes. One, today e-commerce companies and sellers on the platform of an e-commerce company often face problems of an entry tax in different states, and states in some sense are a little perturbed that what is a brick and mortar sale is transferred to an e-commerce sale, and therefore the taxes are going to an origin state. So GST being a destination-based tax, all states will in effect get tax on all consumptions in their states where the purchase is either made either through brick and mortar across the counter in a store, or e-commerce, and even if the goods move cross state. So to that extent, I would think that for e-commerce companies, the largest issue of a tussle with states where they in effect would like the sellers to come and set up their warehouses in those states, that should hopefully go away. Entry tax is also meant to be subsumed, and in any case, the whole objective of the entry tax was indeed a way to ensure or to get companies to come and make local sales. So hopefully these would be things of the past, and to that limited extent, e-commerce see a benefit. But the problem that's come up is the government, and this is not a surprise, we were already talking about it in the past, that they brought about a tax collection there at source, where an e-commerce company would need to deduct tax at 8% on all payments made to sellers on their platform. So if a phone is sold at 10,000 rupees across the counter, sorry, it would attract a GST. That seller would collect the GST and pay the GST. But if it's sold on an e-commerce platform and this goods are sold to me as a customer, I would pay the 10,000 plus a GST. And what the rules in this current form talk about is the marketplace would need to deduct a percent. While one doesn't know, let's just take 1% as an example, and deduct that 1% of the 10,000, make a payment of 9,900 to the seller. This has been done based on some understanding that there is a lot of revenue leakage by virtue of sales on platforms not getting reported. That's the apprehension that states have, and they believe that this 1% may help. Without going into the pros and cons, I think it's just suffice to state at this stage that the compliances would indeed increase for e-commerce companies to be able to meet with the compliance and to be, because they have hundreds of thousands of vendors. And from a vendor perspective, in some sense, by selling on the platform, they would land up having to deal with tax credits. Now, it's also going to be a function of the percentage, but if the percent is 1% in my example, but if the margins of that dealer are so wafer thin, maybe they're electronic products, they're mobile phones, where they have wafer thin margins in the supply chain, will they be able to meaningfully claim the credit? Is this something that I wouldn't completely answer, but it's an issue that clearly is going to come up on account of this concept of a tax collection at source. So, with this, I think there are few other aspects that we need to watch out for. I think some aspects which which is critical to each one of us, is at the end of the day, what would the rate of GST be? But it's good to read the revenue report, neutral report rate of the Chief Economic Advisor of the 18% rate. The Finance Minister on different occasions has stated that that seems to be a rate that they're also comfortable going live with. So what does that mean? It means two things. It means that for product companies today, there's effectively an excise of 12.5% on the factory price or the import price at about 70-80% of the sale price, and then there's a VAT of 14.5%. So give and take on a product which has the normal rate, there's a 22 to 25% depending on what is the factory price or the import price vis-a-vis the sale price, and that should drop to 18%. But for services companies, we will see the rate of tax moving up from 15 to 18%. So, with that being the case, at the end of the day, the rate is going to be quite critical, but that's an area to watch out for. I'm going to pause here and just talk a little bit about what we effectively seem to have gathered in the last 45 minutes, that GST is not a tax change only. It is clearly a change in the way we do business, the way we contract, the way we've decided our supply chain. The impact areas can hence be summarized to the operational impact areas, financial and infrastructural. Operational being your logistics, contracting, and both on the output side, the input side, transactions inter say a company. Financial would mean with rate changes happening, with credit pools getting built up, we will have an increase in working capital. Mind you that today the customs function also is pretty much isolated in most companies. Yes, for a manufacturing company, the bill of entry is used to claim the CVD, but trading companies cannot claim the credit. And most service companies, though the law does allow, don't claim credit. But going forward, another aspect on the operational side is the customs function needs to be completely integrated to the tax function. So companies need to spend a lot of time on the operational analysis on what impact areas it would have. Working capital would be one of the financial areas. The impact on your bottom line because of certain tax credits not being available. Another impact is you may have decided dealer margins to be in that 10,000 rupee phone example. Let me give the dealer 250 rupees because he needs a return on investment. Also, he has rent which has a service tax that he can't claim credit. Going forward, if he can claim a credit, does it merit a revisit of the margins? So I think this GST is not only going to stop at one contract level, you need to look at it holistically. Last but not the least, the third bucket, as I said, operational financial, the third being infrastructural. Most of us on this call would say, okay, even if I need to do a tax planning, I don't mind doing it a month or two later, but I need to be tax compliant on day one. Is this enough time for us? Is 9 months enough to make a start? Can we make the IT changes right now? That's for each one of you to reflect and answer. But I would think that we really need to be moving soon on that front and looking at areas that in not only we need to look inward, but also as an industry, smaller set of companies take back to the government and take it from there. So with that, I'm going to pause. I will then take the Q&A. Thank you for those of you who sent the emails. I do have some emails and I'll answer some questions before I unmute. On stock transfer, there are 2-3 questions. There is an exemption that's been brought about in the rule that says that supply of a registered person to a job worker shall not be treated as a supply of goods. So I'm sorry I'm not able to go into great detail because I have more than a dozen questions, but I'm happy to answer that offline. That stock transfer for a job work shall not be taxable, but there are certain processes and also certain conditions therein. Now, the interesting question that's come in is that how is GST affecting a common man who's a salaried employee? I think that's a valid question. I think that's also going to depend on probably the last topic I took on revenue neutral rate, that what is the rate of tax, and if it is indeed 18%, as a common man, I should expect that product pricing should marginally drop, at least for my day-to-day usage goods, for white goods that I purchase. And so I would imagine that there should be some benefit on that side. But on the services side, my telephone bill, and each one of us, our respective insurance bills, our banking transactions that we have, all of that, the needle of 15% service tax would move up to about 18% as we just mentioned. We also have some question of companies having multiple registrations and movement of goods on a single registration. I would think that if you have presence in any state and the concept of presence is driven more by a concept of business establishment and fixed establishment, please be prepared to take registration in each state. What is a fixed establishment? We can discuss that offline, but very in brief, it is an office that has a reasonable amount of permanence with asset, people, and contracts. That's the general test that one applies to determine whether an office is a fixed establishment or not. And I would think that if you have multiple business operations across the country, even marketing offices, you would need to take registration. A question came up on the stock transfer and supplies. I think I just answered that. And slum sales, I'm not quite sure I have an answer right now for slum sales, but historically, both on the VAT and service tax that has been specifically excluded, we do hope the law does talk about a specific exclusion itself so that we do not have, a problem and interpretation again. An interesting question has come in on SEZs. What would be the impact on SEZs be? The law doesn't just define service tax SEZ. It does not talk about exemption. Offline, we have discussed with the authorities, and there is indeed a thinking, but of continuing the benefit because that is clearly contemplated under the Special Economic Zone Act, and therefore, once it's already specified there, the finance law and the GST law should only be like implementing provisions. I would think that as things stand, this is ambiguous, and we need to therefore be engaged with the government to ensure that we continue to get the benefit that is promised, because a lot of investment has gone in, and obviously, as you said, right, remote and different areas, and this is something that we need to either as developer or as SEZ units, whether it's IT or pharma or whichever sectors we are in, we need to go back because paying taxes and claiming refunds is obviously those of us who have experience takes a long time. But for developers, more importantly, this is a clear cost arbitrage by almost 25-30% or 20 to 25%, I would think. That's an area that we need to go back and have some advocacy. The law in terms of post-supply discount, I've got a question. I think that's an area that we need to examine in further depth. I think what is clearly emerging is that if there's an invoice and then you have a deduction of tax on the a discount on the invoice, that will certainly be allowed. A post-sale discount is not clearly clarified. It says the transaction value calculating including post-sale. I think one of the thoughts that emerged in states where they started discontinuing, and Karnataka was the pioneer in that, was they said, look, we are not going to disturb your credit chain. So if you sold goods at 9,000 with a GST or a VAT, and tomorrow you provide a back-end discount of 200 or 300, we are not asking you to reverse the corresponding VAT. So the VAT chain continues. This is an area that I need to relook at. I'm going to pause here and request the moderator to unmute, and we'll take few questions. I know I've got a couple of more emails. For those of you who have not been able to answer them, I'll try to do it now. Otherwise, I will send you a mail soon after the call.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. We have first question from the line of Tony Singh. Please go ahead.
Yeah. My question is that, this is a very mega change. Implementation and methods of implementation are going to be very important. What work is being done on that, and how confident are we that the government will get its act together on that front? Because, they're not necessarily best at this kind of expertise.
Yeah, thanks, Tony. I think that's an important question. Tony, there's a fair amount of investment from the government on the GST side in terms of, getting their platform for the IT infrastructure, because I think that's paramount. and we've been engaged with the government at state levels for the last many years. Most states indeed have different officers at a senior level with the GST, dedicated to have trainings for the team. But I really think that this, how much work they try to do back end, I don't quite think they will be fully ready. But let's remember that as companies, we need to be ready on day one, but tax authorities will have the ability to actually do your tax assessments 3 to 5 years later. So for them to even gear themselves up completely on the law, they have that added advantage. I think what is a little bit more difficult to answer right now is that even the government and the state and the central VAT authorities and right from the top don't quite know what is going to happen on the administration. So if I'm a services company till today, I was only dealing with a central officer. Do I deal with central as well as the state, or is it only going to be one of them? Who decides who's going to come to me? That topic is still up in the air in some sense, and we need to watch that as well.
Okay. Thank you.
Thank you. The next person is from the line of Mr. Das. Please go ahead.
Yeah, Mahesh, I have two questions. One is that this input service distribution is mentioned. Is it a compulsory to be followed? Like if you have enough output tax liability in the head office, is it still compulsory that I have to still distribute the credit to the various states?
So Section 17 and 18 does deal with that. I think they do use the word may distribute, but as you proceed and you look at the formula, I think it is indeed, I would look at it as for now to be a compulsory distribution, and I would rather prepare for that, because if you even look at the penalty provisions, they talk about where somebody is distributed a little bit more than what was due, it is deemed to be excess. And many conversations that we've had with the authorities in that example of 2,000 software licenses taken by the head office of X company in Gurgaon, and that relates to their 10 branches, they said we will not allow that credit in Gurgaon. So we should probably say it is, it is a compulsory distribution is how I would look at it right now, and we should probably look at it as an area of advocacy.
Okay, thanks. And the next question is that suppose if you get any duty exemption script like SEIS script before the GST comes into the picture, how we would be able to use it after GST?
The transition provisions are a bit silent on that one, but I would think that it's safe to assume that that will continue the benefit, because let's remember the SEIS and the MEIS both are schemes under the DCFT, and they were meant for export of goods and export of services respectively. Those should not be tampered. And how do you utilize them? Today you utilize them for an import customs duty, including a CVD. I think that should continue under GST as well. The transition provisions are currently silent on that, to my knowledge.
Okay, thanks.
Thank you. Next person is from the line of Shantanu. Please go ahead.
Hi. Will the benefits that we have for the EOUs continue for us?
So EOUs today have really one benefit on the excise side. You have an upfront exemption when you purchase goods against the duty-free, and you also are able to import goods duty-free. But on your local procurements, by and large, you have to pay VAT and also pay service tax. So that's the current regime. Migrating to GST, we don't see any upfront exemption, and therefore I would think that both the import as well as indigenous procurements of goods and services would indeed have a GST that will be available as a credit to you. But obviously, if you're doing mostly exports, it would mean that your refund base only increases. But please note, if you're a product company doing an EOU, the basic customs duty exemption should indeed continue as well. But if, let's say, you're a services company and you're only importing, say, servers and laptops and others, I'm just leaving a food for thought that is there any benefit indeed to continue under the STP scheme or not, because you don't have a corporate tax holiday, and if you're not going to be having any GST benefit, you may wish to reconsider your presence in that avatar.
So for a production company, we will continue to have the import duty benefits and CST benefits.
No, you'll have the benefit of import duty to the extent of basic customs duty. And when you talked about CST, the concept of CST doesn't exist anymore. I mean, of course, for petroleum products, that's a different debate, but I'm not covering that. Under GST, there's no CST, transaction levy, and hence you will have to pay GST on your interstate procurement.
Okay. Thank you.
Most welcome.
Thank you. We have next question from the line of Kedar Senapati. Please go ahead.
Sir, any provision on the MRP-based valuation and the area-based exemption, what facilities are being presently enjoyed? So what is the provisions in the GST law?
No, MRP is not there. Let's remember the draft version that was inadvertently put up by the government in December in one of the VAT states. That suggested that there may be some MRP thinking. There's no MRP to levy based on in this draft law. For excise exemption, I think you hit a very important point that I've covered in a short write-up. But the fact is that excise concept goes away. Therefore, MRP-based concept goes away, and therefore the viability to do and manufacturing in an excise-free zone itself comes to. I mean, there's a big question mark, because excise-free zones, the government will indeed look at migrating them to giving a CGST refund for the margin. But since there's no MRP today, really the advantage of doing a manufacture in Himachal or many other states which have the excise, or the few other states that have the excise exemption, is confined to the difference in the cost of the material versus the MRP value. But tomorrow, if it's going to be cost of the material on the input side and services, vis-a-vis the output sale price, I think the margin will be very small, and hence the viability of even continuing those excise exempt plants is up for analysis and a question mark.
Okay, thank you, sir.
Thank you. The next question is from the line of Rahul Kalvari. Please go ahead.
Yeah, I have a question basically from an SEZ point of view. Like currently we have these various statutory forms, like Form I is being issued for interstate purchases. So would that continue under the GST regime, or like how would that be proceeded under GST law?
So Rahul, I think that's a valid point. I think the whole idea that the government wants to stay away from that. That's why stock transfers, there'll be no Form F, interstate, no Form C. And that's the resistance that for SEZ, if we were to give them an exemption, they will continue to have, Form A1 or import certificate or domestic. And that's why they have not yet brought that out in the law. But I think we have to lobby and hope to get that exemption, which my gut feel is that should come through for at least the developers. Be prepared for these compliances and forms to continue, because they will need some checks and balances rather than just a suo motu declaration.
Okay. But do you foresee any major impact on the SEZ units or the developers which may have through this GST law?
Certainly, I think that it all depends on the answer. Will the government give the exemption or not? So if they don't give the exemption for the developer, project costs go up by almost 20%. If they don't give the exemption for SEZ units, it means that while their costs may not go up because they'll end up paying the GST and they should be able to claim a credit and consequently a refund. Today, companies make decisions to migrate to SEZ surely because they're able to get upfront exemption on the input side. So companies' enthusiasm to move to an SEZ itself maybe significant. Will definitely come up, and therefore the possibility of them wanting to continue and migrate comes into question.
Okay.
Thank you. Ladies and gentlemen, this brings us to the end of the BMR phone conference call. In case there are any more questions, queries on the subject, please write in at corporatecommunications@bmradvisors.com. Thank you for your participation. You may now disconnect your lines.
Thank you, everyone. Have a great day.